Imagine you're on a roller coaster. You feel excited and you enjoy yourself while you go up. But when it speeds down the hill, you are left feeling helpless and wishing you could get off the ride. That's how investing in speculative assets with high volatility feels like. It's important to get a good understanding of this concept to become a better trader. Basically, volatility represents how fast and how much the price of the asset changes. It can be low, medium, or high. With low volatility, prices lack the fluctuations that allow opportunities to trade the asset back and forth to achieve profits. Earlier, the stocks were considered a high volatility market. Now, cryptocurrencies took their place. Cryptos have wild price swings. In 2019, Bitcoin climbed 250%, then fell by 62%, had another 46% decline, and a 42% rise, and then another 165% rally. Crazy, right? Here are some factors traders should take into account. First are trends. When the asset is trending strongly, volatility is often high as a result. After Elon Musk tweeted, quote, "I will keep supporting Dogecoin," the asset jumped nearly 10%. News and events. Negative news can cause a crash, and positive ones may spark a rally. Presidential elections, hearings, and regulatory changes can also cause a butterfly effect on the markets. Finally, the black swan. When a black swan event such as a global pandemic occurs, it brings with it explosive, record-breaking volatility. Volatility is what brings profit and opportunity. Without it, there would be no reason to trade. Plus, it's the excitement traders feel when markets are especially wild. On the other hand, there is risk, fear, and loss. Volatility increases profit potential, but the potential for loss increases just as much. Giving into fear or suffering from loss leads to a feeling of failure. Overall, volatility is one of the crucial factors fueling price action. What is the most you've gained or suffered from volatility? Let us know in the comments below.